All right, what's going on, everybody? What's up? You having a good day? Yeah, I had someone just pop up at my door right before I started streaming, and I opened the door and I thought, "Oh, I'm glad I don't work out there anymore." Whew, it's a little hot out there. After all those years of working on the rig and being outside in all climates, kind of got used to sitting behind the desk. So we've got some economic events coming. They're not here yet, and we've got to get through OpEx. So that's really been, sort of the focus on the week. But big picture, there's been some increased signals that are warning us to be a little cautious. And I thought, well, why not just jump through a few of these so you guys get an idea of how to do it for yourself and kind of take a look at what I'm looking at. Most of this stuff is interchangeable. You can do it on different platforms. You don't have to have Thinkorswim or you don't have to have TradingView, but it does help if you have an analysis platform, is what I like to call it. Some place where you can go and do work that is a little more advanced than, say, Robinhood or Webull, Fidelity. A little more than that. If you don't If you don't have something like that, you can always just jump onto the free version of like TradingView free and just, because we're not adding a bunch of indicators or anything. You don't need multiple um, boxes on the chart. So you should be able to use the free version. What we're looking at here is the Mag 7 as a homemade ETF. You don't need to do this. There's an ETF called MAGS, MAGS. You can just use that. But a couple of years ago, we didn't have mags. We had the NY Fang, and that only runs from 9:30 to 4, so there's no pre-market and after hours on it. And we wanted something a little extra, so we made that ETF. But nowadays, everybody that I know really they're just using this. If you don't want this, there's another one that I think is really almost better than this, and it's the top 20. It's kinda new, and I keep forgetting the name of the ETF, but I think it's TOPS. It might be something else, but it is the top 20 stocks in the S&P or in the Nasdaq, and that one's really good too when I remember to use it. Obviously, if I can't remember the name of the ETF, I don't use it very much yet, but I've compared it against MAGS more than once and found that it does a relatively good job. To each their own, right? I'm gonna adjust a setting here. I keep hearing all the beeping and bopping of people adjusting things, and I thought I turned it off before, but it seems like when we get a update, Discord likes to readjust all my settings. We'll see if that fixes it. So, looking at the Mag 7, whether you're using the homemade ETF, the NY Fang, whatever, we're still at an elevated level. We haven't even started to put in any lower highs and lower lows yet. So from that perspective, we don't have anything here that is signaling, any sort of reversal or any opportunity to short. As as all of these tools that we go through, as we start working through them, you have to realize if you're a confirmation type trader, if you're looking for confirmation, you'll always be last, right? Yeah, top T, that's the one. Thank you for that because I was going to get to it by going to look for it, but that is the one. The top T is TOPT. And I don't know, I've compared it against mags and I thought it was pretty good. Um, I like it because it's a little more diverse and yet it's still, you know, got the most important ones. Or I don't want to say it that way. It's got the ones that are like the hyperscalers plus. So it's a good route to go. The Dow 30 used to be my trade list when I was really new. I think that you could replace the Dow 30 with the top T and be just fine trading the things that are in there, really. But looking at this same thing, there's no signal of a reversal or a slowdown. And I mean, I can turn on something like the Z score. I would bet we're not even outstretched yet, right? All things considered. Yeah, no, we're not even burning at this point, right? I didn't need to turn that on. I already had one. So we're past the extreme. If we were in danger or at risk of a reversal from having moved too far too fast, that was at the end of June. And since then, we've already brought our Z score back down. So we're not even at risk of any sort of mean reversion at this point. So, from that point of view, and I even heard it again today. They were talking on Bloomberg and they're like, "Oh wow, man, those hyperscalers, they're getting out of control. They're lifting and carrying the entire market." Yeah, but they're not outstretched. They're not overbought. We could run, any sort of linear regression tool we want. None of them are signaling that it's time to flip. So we don't have that pressure. Then there is this one, and this one is getting a little out of control. This is IWF by IWD. Funny enough, it's a small caps growth versus value tool because it's built off the Russell. And I use it for Mag 7 stuff. Don't ask me to explain how that works, but it works. And I use it a lot. I trust this thing to guide me in the right direction. When this tops out and starts putting in reversal patterns like it did back here, I really pay attention to it. And I think it's fantastic. We don't have that. It's still pointed to the upside. And sure, we got a little itty bitty crink in that, but that's nothing. And that doesn't count for anything. So we don't have a reversal signal here. We did have divergence for a while. If we kind of look at the MACD and we just scoot it over here a little bit, we were making higher highs and higher lows in this and breaking out. But in the MACD, we were going in the other direction. So we did have some bearish divergence for a while, but then it turned around and the MACD got it back above 80. And maybe that ain't a MACD, right? Maybe that's a stochastics. Yeah, it's stochastics. Still divergence. If I did turn on MACD, I bet it also have been divergent. Yep, it's pointing down and this is pointing up. So we had divergence in there. We still don't have a reversal signal. We don't have anything saying it's slowing down or that we should short it or that the only thing that we have here is it's outstretched a bit much. And I've never run a Z score on an ETF ratio before. We could try it, see what it gives us. It feels a bit outstretched, that's for sure. So why not, right? Oh yeah, it's edging up, but it's not at the extreme. Scrunch that and that. Yeah, we were higher back here at the end of June. So we're not even at those extreme levels. This is the end of June, right? Even with this run up, the z-score isn't even back to that extreme level, so it doesn't suggest, any sort of correction or anything like that. Now this other one, this is the S&P's version of growth versus value, and I found it to be more accurate if you're actually looking for growth versus value. In this other one, they say it's growth versus value, but it's really only good for the Mag 7 stuff. And so I came up with this one. I like this one much better if I'm honestly, truly looking for growth versus value. And in this, we can see those lower highs and lower lows. So, growth is taking a back seat and value starting to come back up again. And that's sneaky because it's happening really subtle. We're hearing about all this Mag 7 stuff and the hyperscalers are dominating, but this says they're not. Or the hyperscalers alone are the only growth that's doing any work. Other growth isn't there. So there's a bit of a capital rotation happening beneath the surface, and this is telling us that it's happening. How that's going to play out, I mean, we can get a subtle rotation and then nothing comes of it. It happened back here. We had a subtle rotation to the downside, and that was early February through March. We didn't really get much out of it then either, but it's to be mindful. These are subtle little shakings saying that, not everything is all rainbows and sunshine out there. This one is one that's really got my attention in the last few days. I pay attention to this one a lot. In orange and in the kind of a cyan color is the QQQ and the S&P. And in blue is the ratio that we're looking at. This is US 30 versus Japan 30. It's like JGB 30. And it, as a ratio, that thing moves in step with the market a lot. So when we come in, we expect it to do exactly what the other two lines are doing. And you can kind of see that in the picture. They turn at the same time, they go up at the same time, they go down at the same time. Well, if we highlight certain areas, like just the NASDAQ, for an example, from that low, it hasn't broke that low. If we take that and put it on the S&P, it hasn't broke that low. If you put it on this ratio, it broke that low, right? So it's ahead of the game and it's a leader at this point. It is showing that everything is already starting to roll over to the downside. Now we say everything, but um, we always have to ask who's in control. Is it 0-day flows and dealer hedging dynamics, or is it the dollar or bonds or treasury? And then if it's bonds and treasury, whose bonds and treasury? Ours or some other countries? And they can really dominate, especially Japan. Japan's got a lot of influence in our markets. So that is warning us that there's some rumblings coming out of Japan. And that's not really a surprise. The Secretary of Treasury has said 3 or 4 times this week he's headed to Japan and he doesn't really care about this big economic event that's going on over there. He's going for other reasons. I kind of feel like he's going because of the moves in the 10-year JGB and the projections of how much Japan is supposed to be purchasing. And they were going to taper their purchases for US bonds. And then they said they weren't going to taper as much. And oh, who knows now? So I guess he wants to know. So he's headed over there. Maybe that is why we're starting to see this weakness or this divergence happen. And it may be why the other two aren't moving along in the same way yet. But it is to be uh, something to be aware of. Absolutely. You see a signal like this, it's a really big deal. And if nothing comes out of it, fine. This isn't telling you to take a short, but it's certainly telling you to tighten up your stops in your long trades. And if you can, get risk off the table. If you have a trade that maybe isn't working out that good and it's just sort of sitting on the fences, it's not really doing all that much, maybe get out of that. Get rid of any risk that you can get rid of, because if we do sell off and those long trades that you have aren't really working all that well, that could turn around and put you in a loss. So certainly a warning to be mindful of. I do use that on an intraday basis too, but it's a different chart for that. This one here in the middle is the same one on the right. It just doesn't have the S&P and the Nasdaq on it. And then the one on the left is the same thing again, only on a 1 hour time frame. This is the 10-2 curve, the yield curve. We've been in this flattening ratio. If you look at the weekly, I'm just kind of chopping along here, and then we broke out this week. Banks like it cheap and steep, and that's what we've got. But the banks can't replace the hyperscalers and the Mag 7 and all those guys, and they don't like it cheap and steep. They're the ones that are borrowing money, and they're just not going to like it. So we'll see if how this plays out, but I'm thinking not so good. At this point, it's just something to be mindful of. Hey, the 10-2 broke out. It's headed to the upside. I believe 0.63 is the current next stopping point that we're looking for. How fast we get there is going to be one part of the equation, and then what we do when we get there is going to be another part. When we were aiming for 0.3, we got there, overshot it magnificently, and then took an immediate smackdown. If you look at it on the daily, right, it was like a big blowout move on the week. But then it just come crashing back down, and we lost almost 50% of that move from 0.3 to below 0.2. And it was swift, all things considered. So when we do get back up into that 0.65 like we did last time, are we just going to come crashing back down or actually make it through there? Something to be worried about. We started to roll over in this one. This is the VIX measurement. The VIX 3 month is the front one, and then the regular VIX is the back one. And if you don't know, the regular VIX is a 30-day VIX. So we're comparing basically a 90-day VIX to a 30-day VIX. When the ratio is pointed to the upside, longer term VIX is more expensive. That's the way it should be, right? That means contango. Contango is normal, all systems go, we're good. But if that flips over and the regular VIX is more expensive than the VIX 3 month, then this is going to head to the downside. That would put us in backwardation. Backwardation is not good. So 118 on the upside, 1.0 on the downside. Generally speaking, when this crosses from below and is headed to the upside, trading Mag 7 long generally works out. And by long, I don't necessarily mean, like run out and buy calls, because that would require like momentum and trend, that sort of stuff. But you could run like short puts, put credit spreads, those sort of things, on the idea that the Mag 7 constituents shouldn't be bearish or headed to the downside. They should be flat, holding steady, and or rising. Of course, headlines can change that. Musk, for an example, likes to run his mouth and get Tesla in trouble and can send that to the downside while the rest of the Mag 7 is doing good. Or the CEO of NVIDIA, NVIDIA can get headline news that knocks it down while the rest of the Mag 7 are running. That sort of stuff happens. But generally speaking, if this is headed to the upside, the Mag 7 should not be weak and falling. But the other way around, if we come back in from above 1.8 and we're headed down, then Mag 7s are usually a decent short. Short term shorts, right? Like we had back here. It lasted like a week and a half at most. And then we went right back up again. So we started to roll over, and I was thinking, maybe we get some shorts, but it stalled out. We didn't even get anywhere. If you go back and look, a lot of times that's what it does, is it stalls out around the mid and just comes back up again. We don't get a lot of these really deep, steep drops. That's when things generally go wrong. They get really nasty. Even this one from earlier in the year, we had that Liberation Day event, right? And it cumulation. It ended after the 7th. So on the 2nd, he announced everything. bond vigilantes through a fit and it ended and then we ran back up, right? So that's kind of the when things get bad sort of look. Well, we're not there. We didn't even make it back to the mid. This is still elevated, so another signal that it's not time to short the market. Now, this is a monthly chart. You could look at it on a smaller time frame. I never do. It was designed for this time frame, and we're really just it's like a gauge on tech, and it's broad generic tech, not like hyperscalers or anything like that. It could be any kind of tech. And technically speaking, as long as this is green, you don't want to be shorting tech. And when we are red and we do go down, we expect it to hold at key levels. And if it doesn't, then things generally get really nasty. So I watch this for areas of previous resistance or previous support. And right now we're coming up into this liquidity cloud. We tried here, it didn't work. We tried here too, and it didn't work. And now we're right back in that zone. So I'm a little concerned. And this adds to the hey, we need to be careful right now group, right? Because this is telling us that at the end of OPEX, we could start that last week of the month heading to the downside here, getting rejected off of this next Monday, right after we get done with OPEX. That if we was going to reverse, this would be a darn good place to do it from. Then we've got weighted versus unweighted. By itself, it's still pointed to the downside. And if you look, it broke the previous low. So we're getting down into levels that we haven't been like forever. I'm sure we've been there before somewhere, maybe way back in the day, but it's been a long time, right? If we ever have been as low as we are, yeah, it's been a long time. So all the way back to the 2007, 2008 financial crisis. Oh, that was just last month. We're there, and we want to be mindful of that sort of drama. But we got the market at all-time highs. It broke the previous resistance and has expanded. This broke the previous support and has expanded. They're matching in their exuberance, and there's really no tell here. If this starts to turn around like it did back in in July, then we'd want to be more mindful. All right, see that pivot point. The purple line, by the way, is the S&P, it's the SPX, and we flipped here to the downside. We flipped here to the upside. So if this was pointed up, we'd be a little more concerned. We don't. It's not pointed up, but it is getting a bit extreme. Yeah. So a little bit of a warning there. It shouldn't be pointed straight down, right? That's not good. Now, the last one we were on, this one is really popular, but I like this one just as much. It's the same thing, but instead of looking at SPY, it's looking at the Qs. So it's weighted versus unweighted in the Qs. Same drama. If it's headed down, the Qs are in control, and if it's headed up, then the QQQE is in control. So the Mag 7 dominate when this is headed down. It's the easy way to think of it. Funny enough, same thing over here though. The Mag 7 dominates when this is headed down, and they're dominating right now. So if this was to turn around and start heading up, then we'd be a little more concerned, right? Like back here when the Qs had that spike to the upside, this dropped really hard, and there was some discrepancy there. There's things were like it's not, it's going in the wrong way. So just be mindful. This one often that's Christmas, December 24th, 2024. It's where this run ended and things started to change, but we really didn't see a change in the Qs right away. It took a little bit, right? Then finally, it is like it tried to play catch up all at once. So this doesn't always move the way you would expect it to. But I like this one because it's the Qs, and the Qs, they tend to be more impactful, more dominant. So all of these things, when you put them together, it says that there's some risk starting to show up under the surface. There is there's a product, a broker called the TC2000, and that TC2000 uses old school market breadth tools that we can't get unless you have that platform. One of those tools is called T2104. It's the cumulative volume index. And generally, you could just Google that and go right to that broker's website and see them. But their website, their help support website, has been down for like over a week. So I can't even show you the broker's website's support page, which tells us what those tools are that they use, how they was calculated, and then how we could use them. But even though I don't have that broker, I do have access to some of those indicators, those charts. So I'm going to just take a picture of each one of those and put it in the chat. And then from the chat, we'll bring it up on the screen. So this one is T2104. It's the cumulative volume index. It's on a daily. This one is 2123, which is the cumulative week, new high, new low. This is 26. And this is 2100. Later on, when they get their website back up again, you could Google these four, and they were produced by TC2000 broker. Because that's a US broker, by law, they've got a website page that explains what these things are, right? That's what brokers have to do. But the site's down. So, they have it, but you can't access it right now. The reason I'm bringing these up is these have been in a solid like uptrend for a while. Let me bring what I'm looking at over to the screen so you guys can see it. So it's a stochastics on the bottom. And when the stochastics is above the 80, which is this green line, and it's tangled up like this, that's like having your foot on the gas pedal of your car pushed all the way to the floor. I know people like to think overbought and overbought's bad and that you should short overbought markets. I'm not a fan. I don't play that way. When we get overbought and we've got this tangled up stochastics, it's telling you stay long, that they're pushing on the accelerator as hard as they can push. And you don't want to get in front of that. Well, that's what we've had, right? Through like the end of June, we get into July, and it's been that way through July. It's just been this tangled stochastics, and well, now we don't have that. Right now, we broke or are breaking down into the stochastics 80 level. I was looking at it on another platform, another chart, and we were already down through 80. So it's not showing it here. This is a delayed product because I don't have that broker. I have to, get little workarounds. Maybe it's because of my delay. But even when it does break down, if we look at the cumulative volume up here, when we did break down, it just stopped going up. It's not like we crash and burn. It didn't do, one of these moves. So that could eventually be what happens is we get a rollover and the stochastics gets below 20 and the 2104 actually starts printing red candles. But at the moment, we're just expecting it to stop. And if you're wondering what the hell is this, it's the cumulative volume index. And there are modern versions of a cumulative volume index, right? You go to your own broker, look at indicators, and just type in cumulative volume. You'll find it. TradingView's got some pretty decent ones too, but it's not that one. It's close, right? They're kind of the same. They're not the same. They're a little bit different. I'm not saying that one is better than another because this isn't about better or worse. It's just how it was developed, what the criteria is, what the math is. So this is TradingView's version of the cumulative volume index. That's that white line right here. And I've laid it on top of the NASDAQ. That's the IXIC right there, NASDAQ Composite Index. And if you look at the cumulative volume here, that sucker's still pointed straight up. Same thing here on the daily. It's still pointing straight up, but look at price. Price has already started to roll over here. So maybe it's just a little bit of a discrepancy, right? Price on the NASDAQ fell here, and we had a little bitty blip, but then we just kept on going. And 3 days where this was going sideways, or 4 days, NASDAQ wasn't doing nothing. That indicator just kept on going. The buying volume, net buying volume is what we're looking at because it's going up. If it was going down, it'd be net selling volume. The net buying volume is still really strong. They're not slowing down even a little bit. It's just all go, no quit. So don't get in front of that. Thinkorswim has one of these too, by the way. If you're on Thinkorswim, just type in cumulative volume index or CVI, and you'll find the CVI on Thinkorswim. I like TradingViews because you can choose to put all of the volume together from all of the markets. And on Thinkorswim, you can't do that. So here it asks, what do you want? NASDAQ, NYSE, ARCA, US total. That's cool. You just put US total and look at all of it. You can't do that on Thinkorswims. It's okay. You know what I mean? Like, just pick one. We're looking at NASDAQ here. That's all you need. Just pick the NASDAQ. So these other ones, like 2123 and 2126, they all have their purpose, right? They all have a spot, a particular thing that we use them for. There it is. So this is like market breadth. How many out of the broad market do we have going up versus going down? And this has been topping out too, right? Look at that stochastics. It's just been this tangled up spaghetti. You don't short that. You know what I mean? Like, I don't care what they say about, oh, it's above 80, it's overbought. You should sell it. Not me. You're getting out right at the best time. Let it throttle up. When you put your foot down in the car, right? You stomp on that gas pedal and put it to the floor. You're not instantly going as fast as your car can go. It's got to accelerate and get there. It's the same thing here. When it topped out and it started to tangle and it was saying it was, quote, overbought, that didn't mean that it had reached its max acceleration. It was just getting started. And if you're long, you don't want to stop now. So it dipped back here and it just got a little slow. That's all it did, right? It didn't fall. And now we're where we are now. It's still above the green line. We're seeing a little bit of red, but we got nothing here, right? Right? Market breadth still says we're good. All right, let's see what we can do with this question here. Is there a setting in price to make it easier to move the ratio around? When I do it regular, it does not show the SPX. And when I select percent, I can't get the chart to move around easily. And it looks like you're on TradingView. All right, so here's the thing. When I make a chart on TradingView, let's just make a new one. So a new layout, and we're going to use the US 30. So I'll just start with US 30, and now I want to add another market. So I'm going to go back in there, divide by JP30, and now that's my ratio. All right, that's one thing all by itself. That's not the right ratio, by the way, but whatever, it'll work. That is your ratio. Now, what I seen in your picture looked like something like you went and hit the plus sign here, and then you added the SPX. And if you do that, use new price scale. Don't use same percent scale. If I use new price scale, now they're both working together. right? And I can turn mine into a line to match the line. Now I got two lines. So do that. And that way I can zoom in, I can zoom out, I can change time frames. They'll work together better than nothing, right? But if you remember when I was here, watch this one. In fact, I'll make it big. So they all three start from this starting point, touching each other. And then as time went by, they spread out. And if I start to zoom in here, see how they're shifting around? And if I shift them too far, they'll all start to overlap each other. It's just the way it is, right? And there's no way that you can fix that. So what I do is I roll it into where I get the best point of view, like right there's really good, and then I stop because that's giving me the best image that I could get for the current situation. And if I zoom out, it looks like this ugly mess, right? So it's not perfect. None of these programs, do a perfect job. But when you're adding things, just kind of play around, try different things. If I remember right, there was a reason to do same percent scale. I read an article that they wrote. TradingView did. They did an article on this, and they had a really good reason to use this button. I just can't remember what the hell the reason is. I always use this button, and that way they seem to be visually better. But I'm not having any memory of this one. Maybe I'll find that article, right? That because they did have a good reason. I don't remember what it is, but they had a good reason. So market breadth tools that we looked at so far, this is like broader market breadth context. This says everything's fine. Don't short the market. The cumulative volume, everything's fine. Don't short the market. This one here is the only one I believe out of the four. No way, this one and the other one, advancing and declining, because they're both and decline. One is just for the Nasdaq, which is this one, and the other one's for NYSE. The advancing and declining issues are starting to roll over. This is our first signal of weakness in the broader market, but it's just a wink at this point, and it's not telling us to short anything. But that's our first one, right? We've got that one, and then we've got the other one. And this one, it says NYSE or Nasdaq right there. This one does not say that it's the NYSE. I know it is because I've read it on the website enough times. But it also has the rollover started. The thing is, this one's at least got red candles and a rollover. This one doesn't. It's green candles and it's rolling over. A little bit of divergence. So if we had all four of those giving us bearish signals and we're below the 80 on the stochastics and pointed down, I'd be much more interested in shorts. If all of those market tools that we were looking at on TradingView, right, my growth versus value and the Apple Mag 7 complex, if all of those were saying shorts and they were rolling over and topping out, giving us reasons to look for shorts, I'd be more interested in a short. We don't have none of that. We've got a little bit of overbought on IWF, a little extreme. And then we've got the stochastics on those two advanced decline indicators dropping below 80. It's not even cutting through the 20 yet or getting tangled up below the 20 at all, right? So we don't have a short. We don't have any signals of a short. We've got some cautions about being long, but we've been running under a cautious flag for 2 months, right? And it just keeps going higher and higher. One of the things that really stands out is that they keep talking about how these tariffs are so bad for us, but we're a service based economy. We don't manufacture, right? That's one of the things the administration is trying to bring back is manufacturing. We do some, but not very much. Most of our economy is service based. These tariffs aren't hitting us because the services are still running. Goods might be starting to pick up in price a little bit, but they're not the broader part of our economic backdrop. So everybody kept waiting for these tariffs to hit and really do damage, but they didn't really do any damage. And it's likely that they won't until something else happens. Now, what that something else could be, who knows? It might be that the dollar finally breaks or yields, or maybe he actually fires Powell. That could probably break things. That was some of the news that was coming out today is that he was, asking around again about firing him. Markets might freak out over that. Well, it's like when you have a lame duck president, right? He's still the president, but he's a lame duck and absolutely nobody will pay attention to him, right? He's completely worthless. What if you do that to your Fed chairman? You just cut him off at the knees and he has absolutely no power to do anything whatsoever. Sure, you didn't fire him, but he's impotent and completely worthless. I mean, I'm not saying it would be easy, but that's why he's asking around, right? Like what's he's trying to find solutions to how do I get rid of this guy? And tell me that he can't find some shady, underhanded way to wreck this guy's life bad enough that he decides he's going to leave. He's already ruining his reputation, however good it was, smearing, his years of service. Is that going to be his legacy? And is he willing to stay in and tarnish his legacy just to stay in for the last 9 months of his tenure and ruin what, 19 years of service? What's his breaking point? We all have one. So, legally, technically, can he just reach out and fire the guy? Nope. But you can bet he'll make his life such a living hell that he will quit. He can do that. And the markets aren't going to like it. It's supposed to be a independent system. right? Where everything runs with checks and balances. And if you put a yes man in there and eliminate a check, then in the short term, the markets are going to get exuberant, right? Because then he'll have control of House, Senate, like all the board, all of the different branches, every sector, everything. But it's going to break things, and that's the problem. It will break things, and there is historical precedent, right? There was a president who fired his Fed chair, and the guy that was supposed to take it wouldn't take it, and so they fired him. And the next guy in line said, "Well, I'm not taking it either," and then they fired him, and it went down the line until somebody finally stepped up and took it. There is a precedent for that. Um, I can't remember which one it was, like Truman or Johnson, one of those guys. But it was a maybe FDR, I don't remember, but there is a history of shenanigans like this happening in the past, and that was back when most people didn't hear about news until months later, right? It wasn't like now when news is instantaneous and everybody around the world knows what's going on. So who knows what's going to happen? But it is a big deal, and the markets showed a little bit of behavior on that today with the headline. What I'm looking at right here, this is like liquidity, and the ES is on top. I posted the picture in the chat earlier today. We broke a major trend line that expands from all the way back here in 2024, but the liquidity is still up. It's elevated, but you can see this kind of a blow off top pattern at the end of June into July, and it's been slowly sort of trickling down since then. So we set our high, and we're looking for lower highs and lower lows now. And sure, if I zoom in, we can sort of start to see some trended pattern on that, but it's just barely getting started, and it's still well above the marker level. The marker level is way down here, a line in the sand that it needs to stay above somewhere. There it is, way down here. So we're nowhere near that level. Um, and we could even use the halfback on this, really, all things considered. That was the breakout point where we started to really come back out again here in March 2025 and started this run. We started it here, right? The April 2nd, and then the April 9 capitulation, and then the run, and we came up through the yellow line, and we've been running ever since. So we're not back to the yellow line. So liquidity is fine. But if we start having liquidity issues, we'll start to see it here first. This is one of those that you won't find on Thinkorswim. So it is a trading view chart. I can give you guys the highlights of it, or I could just, if you have trading view, just import the whole chart. So this is Fed liquidity. And the major line in the sand is the yellow one, which is the halfback at the moment. And we're not even close to that level. But liquidity is, starting to wane a little bit. And we got QRA coming at the end of the month, which will affect liquidity also. So we want to be mindful of that. See what other goodies I have in here. So this is put call ratio. I don't think that's the one that's supposed to be in here, but we'll look at it. It's actually the put call ratio of just Apple, which is funny. But you can do that nowadays. I think it's kind of neat. If you have a particular stock that you like, Tesla, Apple, Microsoft, whatever, on TradingView, you can look for put call ratio of those particular companies that you want. You don't need a fancy subscription like you used to need back in the day to get those sort of put call ratios. You just get it on TradingView. So that wasn't the one that I was looking for. There is actually market breadth tools, And you can get those on Thinkorswim too. It's worth pointing this out in case you guys didn't know that this is here. Up at the top, make sure I don't have any indicators on because that won't do any good for where we're headed. Where you can put in a market symbol, that drop down has a bunch of choices on it. And where it says indicators, that's not indicators like a MACD or a stochastics. It's not those kind of indicators. These are market breadth indicators. And they have indicators in there for stocks above their 200-day moving average, stocks above their 500, 150 period, whatever it is. So you can go in there and you can find all sorts of market breadth indicators, which is kind of cool. That way, if you don't know what the symbol is, you don't need to know. You can just go in there and just kind of shop around, like, oh, I want to see what this is, and click on it, and there you go. So new highs and new lows. If it's 1 week new highs, 1 month new highs, 1 year new highs, which is kind of neat. And you can compare these to each other too if you use the minus sign, or you can copy the symbol and then you can use the indicator called the ratio indicator and you can put them in there. So there's ETFs that make new highs and new lows, uh, advancing minus declining volume, all the breadth tools that we were looking at from the TC2000. You can kind of build your own versions in here using these, which is it's kind of neat. What I'm scrolling for right now is the stocks above because that's a nice one. And TradingView's actually got indicators for it. So you can be looking at SPY, and then down below, you can have an indicator that shows stocks above their 200 or stocks below their 200, that sort of thing. Makes it nice for comparisons and ratios. But that's a broad market perspective of how healthy is the broader market and are we getting too over exuberant. I was having a talk with somebody today. You guys ever heard the story about before the Great Depression and the big financial crash of the 20s? There was this story about a shoe shine boy working on Wall Street, and he was giving stock tips to people and telling everybody how amazing the market is and how they should be, go in all into the market with every penny you got because it just keeps going up and it's so great and it's so awesome. And this is some shoe shine kid working on the streets back in the 20s or right before the 20s. He had no idea what the hell he was talking about, but everybody was in the market and everybody was long because it just kept going up and times were good and yay. So this really savvy analyst was getting his shoes shined, listening to this kid babble on about stuff that he had no idea what he was talking about. And the guy realized, Jesus, everybody's long the market, like blow off top kind of stuff, over exuberance. And he loaded up on shorts. In the last 6 days, I've had so many people throw me drone watch lists, comparison studies, news articles, social media mentions from the influencers everywhere. Everybody's so hyper focused on drones right now. And I was at the grocery store the other day, and some kid was telling me I should download Robinhood and trade up these drone stocks. He didn't know me from anybody, he was just running his mouth. Yeah, I'm not kidding. I'm looking at this kid, and I'm like, so what's this Robinhood thing? And he's like, oh, it's a broker it's just so cool. You just get this app on your phone and you put money in it and you can buy stocks. You should run in there. You should do it today. He said, look at these things. They're just going nuts. You should buy these drone stocks. He didn't know who I was. He was just running his mouth, but it's getting a bit nuts out there, right? When my bag boy sacking groceries at the grocery store is giving stock tip advice to people, you know, I think we've reached the plateau. And if you guys don't know, what happened with the 1918 or 1920, the great financial collapse that put us into the Great Depression. being short was a good idea because it all went crashing and burning back then. It's a real famous story, that little shoe shine kid. I don't know if they ever identified the kid, but it's nuts, right? So if you're getting stock tip advice from the guy that's hooking your cable up or sacking your groceries, things are getting a little out of shape. I cannot find what I'm looking for. I did put articles on Thinkorswim about tick and trend and the math formulas behind trend and how you can use it, what it's for. Those are really intraday sort of tools. I'll probably have to circle back to it since I'm very likely just running through it too fast. But it's where all of your advanced decline is at too. So it's just really good stuff. Oh boy. So what do you all want to talk about today? There is a really fantastic tool. I don't know if we can get to it without having a subscription, but it's called the Carpet on stockcharts.com. Market Carpets. Nope, that ain't the one. I thought it was called that. It's something else. And what this there it is. This thing. Well, you're looking for a rotation in the markets. This thing is phenomenal. These lines, and by the way, TradingView has a bastard version of this, which is really cool, but it's kind of ugly and it's hard to see. I want to show you guys where I found it on TradingView, and you can kind of play with it. But this has boxes of lagging, weakening, leading, or improving. And then when you run it and you set the time frame, the tail length, it'll run through and it'll show you which stocks or sectors or industries are moving and where they're coming from and where they're going to. It's really fantastic when you think about it. Right now, they've got it looks like companies and indexes here from different nations. You got Canada, the S&P. So they're list is right here, but we can swap it out, put whatever we want in there, right? We could put sectors instead of these indexes in it. What else you having with it? Just rice and beans, or no? Just that too. So I'm not signed in. I don't believe you need an account, but it won't save your settings, right? So if you do jump back and forth here and you want to do it more than once, just save the site and then, remember how you did the settings so that you can find it again. Uh, Swap those names out with the names that you want and then activate it up at the top. You can, turn it on and it'll run through however many years. I think it goes back to 1988. Um, no, 1968, I think, is how far the last time I ran this. And I was doing it on yields when I did it. I don't know if they've got data that goes back to the 80s on stocks necessarily, but when I was running it on the 10-year yields, it was really cool. So there's that tool to help you visualize a sector rotation and what's strengthening and what's weakening. So as for the TradingView version, see if I can find it. I'll still go two. Let's see. Euler's Loop. I'm pretty sure that's the one. Yeah, that's the one. So they have it with some like Bitcoin and S&P. So what, right? You open this indicator up and you put whatever you want in it. So you've got 5 spots. You could put 5 sectors in it and then run it. And of course, you can load this indicator more than once. So you could keep S&P in there as your solid benchmark and then replace these other 4 with sectors. And you've got 9 sectors to run. You could parse it out, right? And then there you go. So it's called Euler's Loop. Big Beluga made it, and that's on TradingView. And that way you can kind of get the same thing. This doesn't give you an automated visual. It's not going to, like play video like the other one will, but the tail gives you an idea of where they've been and where they're going. And that would be really helpful for visualizing a sector that is increasing or decreasing in its strength. And the user article that goes with this tells you what each of these 4 quadrants are so that you know which ones, the leading, lagging, strengthening, whatever, right? So that way you'll know what the 4 boxes are too. So hopefully that is a really good tool to get you pointed in the right direction. So we had a question on thematics, which is near and dear to the way that I trade for sure. So how do you find the next theme? I'd love to tell you that there was some website or something that you could go to, but unfortunately, there's not. It's more of word of mouth, social media, news articles, headlines, and that's how I find the next theme early. The earlier, the better, right? And it's not always easy to find. We've been dominated by AI for a while, and they take up a lot of oxygen. But behind that is I do the watch list every morning. So I see the same names popping up in that watch list over and over and over. And I'm the one that posts it in the watch list channel. And when I see the same names just showing up every day, every day, every day, getting a bunch of attention, I tend to go shopping around and seeing, hey, what are these names and what do they do? Because they're almost always names that are not on my radar. Apple and Google's on my radar, right? I don't ever need somebody to tell me, hey, you should look at Apple. Shut up. I'm already looking at Apple. I look at Apple every day. Like tell me something I don't know. So when I see somebody mention some Joe Schmo company that I've never heard of, and I can see that it's getting attention day after day after day, I'm going to start looking around and find out what sector it is, what industry it is, what banks are behind it, who financed the darn thing, how long's it been around, what news it has, 'cause I want to know more about it. So that's a really good way to go. Um, Keeping your eye on that morning watch list. Sector ETFs, they're just too vague and they're too big. You want industry specific ETFs, but unfortunately, that's a massive list, right? But if you can find outlier ETFs, for an example, UFO for space, because space is getting hot. It's just not as hot as drones and robotics and AI and quantum, but space is there. It feels funny or a little silly, focusing on an ETF called a UFO and looking at space stocks. You know what I mean? We're grown adults looking at space stocks, just like aliens and stuff. But hey, it's a sector that's hot. So you got to find the outliers, and then it's just a lot of reading articles, following up with companies, getting past the headlines and seeing what's actually moving and why it's moving, and word of mouth. Thankfully, in the position that I'm in, people throw stuff at me all the time and ask me to look at it or to dig deeper into it. And then, of course, if 30 people are asking me about some EV company that I've never heard of, then well, it starts to get my attention, and I dig a little deeper into that EV company. So that's how you find those early. It's just by crunching the numbers and reading the headlines and the news. And I was able to do that even with a full-time job because I had to drive an hour to get to my job, and then I had to drive an hour home. And of course, I couldn't fiddle around with my phone and technically because I was driving. So I'd have to listen to podcasts and YouTube videos and that sort of stuff. And so I would have time to hear the news of these different places doing different things. And that helped because it just takes time. So you could try that. I did share two watch lists today. They were Excel spreadsheets on um, ETFs. And no, I really don't. And I'm going to answer that question the same way somebody gave me an answer the other day because they were talking about a website that I had not, I'd heard of, but I had never gone to until they kept mentioning it over and over. And finally, I went there and I was like, oh, wow, this place is pretty cool. But a lot of it's locked up, right? So I asked the person, hey, do you have a subscription here? Because if you do, maybe we can little quid pro quo. You'll give me access to this, and I'll give you access to one of mine. And they're like, no, I don't have access to it. I just read the free stuff. And their answer when I asked them was, I'm too busy to dedicate all of my time and attention to just one website. There's just too much going on and I can't expect one site to have it all. And I really like that answer because that's true. I really wish there was some go-to site that I could just give you that always keeps you, on the cutting edge of everything that's going on, but there's just too much data. You have to be willing to jump around to different sites. And I've got emails at a junk emails. I keep just one email address that's, my junk list. And that thing's got thousands of emails coming to it. Some of them are like AI newsletters, drone newsletters, quantum newsletters, cutting edge newsletters, things that are hopping, the 10 stocks you should buy this week sort of trash. But, if you see those headlines and they're hitting the same theme over and over and it's early, something you hadn't even thought of or wasn't even looking at, then, they get you pointed in the right direction. But no, I can't name just one site. You should be looking in multiple directions daily, constantly, because that's how you're going to find it. We're drowning. right? All of us, we're just drowning in data. So what we're looking at right here, this is called Bespoke. It's free to see the stuff that you see, but if you want to, like dig in behind the scenes, it's not free. And they have really good stuff, I got to admit, and an interesting perspective. So without paying anything, you can just go to Bespoke and check out these tools that they have and try to find things like this, right? Try to find things that will give you um, reasonably decent material for free or really cheap. I've got subscriptions to things like Market Gauge and Market Beat. My Market Gauge is free. So that one doesn't cost you anything. And they have reasonably decent stuff right on the front, so you don't have to pay to see anything. This lady, Mish Schneider, she sends out an email every day where she reviews the ETFs. She created like this little family of them. Like mom is one ETF and dad's another ETF, and then there's grandma and grandpa and whatever. She made it user friendly even for new people. And I read that when I was new every day to learn more about how the Russell interacts with transportation or whatever. It's free. It's an email and she has weekend stuff. It doesn't cost you anything. Try to find these sorts of sites that give you access to material and it doesn't cost you anything. The one that I pay for, it's like $5 a month, Market Beat. It's $5. You know what I mean? Like, I don't care. I don't like spending money, but I'm not going to cry about it. This one is really helpful and it's loud. It's got the ads and the pop-ups until you sign in and then that stuff gets cut off and it's not as bad. And don't careful what you click on if you get these guys because they will bomb your email nonstop with stuff. Yeah. And bar charts, bar charts will choke you out too if you're not careful. See, this isn't even the right one. It just recognized my Google account because that's what I'm logged into on this browser at the moment. And it signed me in, but this isn't even mine. This is like a free account. This ain't my account. So I'm gonna log out of that and log in on mine. See, it's trying to do it again. No, go away. Hopefully I'm on the right one now. Nope. Be ready for it this time. These things, they start to take over after a while and try to run your life. So these guys got a pretty good ETF scanner, and I've used that before. In fact, I used it to post the ETF list that I shared earlier. I shared two, one with 1 million volume and then one with like 20 million volume to really tighten up the ETF list. I did the 1 million because I wanted a broad outline of ETFs to run on Thinkorswim. And that way I can sort it into different categories and run it through filters. But I also wanted a really tight list that didn't have a lot. And it was surprising to me how many double and triple leveraged ETFs have the top volume right now, more volume than SPY on average. And that is impressive. So I did filter by, I only wanted equity. I didn't want, like multi asset and fixed income and that sort of stuff. So got equity and then average daily range. Count the zeros there. That should tighten it up. Maybe I need another 0. Do 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 do. Maybe it's not awake. I got enough zeros in there to kill an elephant. Hmm. Maybe I broke it. Wow, it's freaking out. It's getting there. Anyways, what shows up is like these double, triple leveraged, and then SPY, and then like one bond. That was as what it all came down to. So I had to release some of the restrictions a little bit to get it to the point where it was actually usable. I think I broke it. So if you do scroll up in the chat, you'll find the 2 ETF watch lists that I shared. I'm pretty sure I still have them in my downloads because I haven't had a chance yet to upload them to Thinkorswim. Here's the 10 million volume. And as you can see, it's a short list, 37 names. Let's just grab that and put it into Thinkorswim. The other list was a lot larger. Average daily volume 100,000 million. And if we sort, I'd have to turn this thing into a table. Largest to smallest. SOXL was the top, and then TSLL. That's a 2x bull, Tesla bull, no less. And then semiconductor triple X bear was next, right? I honestly thought SPY would be top dog in this, and it was not. These other ones are running 100% more share volume on a day-to-day basis than SPY, which, to be fair, they're like $25 stocks versus SPY at $622 stock. But still, I mean, it's impressive. That's a lot of volume on a daily basis. And I wanted to shop around with these a little bit. If they're getting that kind of volume, I was curious, like what did their options look like, or so I threw it in the chat. I just never got around to dealing with it yet. So let's import them now and take a look. Oh, it didn't. It didn't keep. Fine. Oh, okay, stop. Let's see what we get out of these. Breakouts yesterday. We had a couple. Palantir, double X leverage, China stuff, a lot of bullish momentum, a lot of bearish momentum. Not bad. It's a good start. AMD double leveraged. Okay, this is a 2x long AMD. And it's $10, right? I mean, AMD's been running pretty good. What kind of options do we have on these things? Oh, that's trash. Okay, no options on that one. Emerging markets. Yeah, we know it's got options. Brazil, probably not very good options. 30,000. Triple X Financial ETF has options, but no volume. Nobody's traded this thing today. Like nobody. That's funny. That's a good question. If you guys want to nerd out on Thinkorswim for a moment, so Thinkorswim gives you the opportunity to make indicators, but you can also make watch list columns. In fact, you can take the watch lists, the indicators that you made from the indicators section in here, where you just create an indicator, and you can stick it into a watch list column. Now, when you open Thinkorswim, you get the account, you get like 21 spaces to import your own in watch list columns. After that, you can do more, but it won't show up in other areas the way that you would expect it to. So be mindful of the original 20 that you get. And the reason I say that is because these watch list columns that we're looking at, they will work on your options tab, which is really cool. And they'll work in your phase score. But after the initial 20, if you get another 50, those won't show up. Okay. So how do you make one? Well, you go into this area here where I just went. So you go to this little gear icon right there. First, open up a watch list, any watch list, doesn't matter. And there's a little gear icon right there. Click on it and hit customize. Once you open that up, hit the drop down button right here and scroll down to where it says custom quotes. And that'll show you the 10 that you got from Thinkorswim that can be modified. I don't remember what their name is, but they probably say like new indicator or blank, or it should have something there. Those are the ones that you can make, use, modify, do what you want with. What it looks like is the same thing it looks like when you mess with Thinkorswim code for making indicators. So it brings up this area. And so you can run, the ThinkScript editor, or if you're doing something like moving averages or something, you can probably use the condition wizard, but we're not in there. We're in the ThinkScript area because this is like impulse. It might help if you just take one that has already been made and import it. I have shared all of these before and they can be imported. They're in the Thinkorswim workbook because along the way somebody has asked, "Hey, can I have those? Those are fantastic. Which ones are they? What are they called? Where can I get them?" And I built a whole list out in the Thinkorswim workbook. So you would go into the Thinkorswim workbook and type in something like watch list columns, and you would have a good place to start. So it's just morning briefing watch list columns. That would be the one that you would want because I believe that's the one that everybody kept asking about. And it has those that I was just showing. Um, yeah, tech rank. Here's the whole kit and caboodle. Those are the ones that I use the most. So you can just go into that room, copy all of those, and import them in one chunk, I believe. If not, just doing one at a time. These will work in your phase score, and they will also work on your options column, which is pretty cool. That way, when you go in here, for an example, and you open up custom column sets, you can find those same ones just like that. Pretty helpful if you're going to do like options scalping and that sort of stuff. I just loaded volume and open interest, but whatever, same stuff. There's all sorts of things in that workbook. Just remember that there is a search feature in the upper right, and you're going to want to use it because there's just so much stuff in there, right? The categories on the side, I mean that's one thing, but just to kind of give you an idea, that Discord right here with the white background, that's all Thinkorswim stuff. The one that I'm looking at right now, yeah, that's Thinkorswim stuff. Then this one as well, and that one too. That's 4 different Discords that I have that I'm showing that all have Thinkorswim stuff in it, right? That that ain't even that's not all of it. I have another one besides those. So, then I've got like a file that has little text documents just full of that stuff. Some of it I made, some of it I found along the way. Um, yeah, I don't put anything in there that would get me in trouble. So if it's a paid for indicator, because I have some of those too, I won't put it in there. Those sorts of places, they'll sue you for trying to share their stuff. Like, oh, just for an example, Carter over at Simpler Trading, he's got a bunch of indicators for sale, and I happen to have a lot of them, not because I bought them, but just because I have access to them. I can't put those in that Discord because, yeah, I don't want sued. And don't ever buy indicators, guys. Honestly, unless it's doing some fantastic thing that you've never seen before and that you can't get in some way somewhere else. And even then, probably don't want to buy it. Don't buy it. See if you can get, the AI to make it for you. Ask in the chat something because 9 times out of 10, we can recreate whatever it is once we know what it is, right? There's a few exceptions to that rule, but not very many. For example, there's this tool on Thinker on TradingView that is absolutely fantastic, and I've never seen anything like it. It's a really powerful tool, but I don't know any other way to do it, right? So I've got a free version of it, which is kind of neat to have the free version, but of course it's limited. It doesn't give you everything that you would want. and it's limited by the stocks that it will look at and then how often it looks at it. And it's an options indicator on TradingView, which is rare, right? Because TradingView doesn't really dabble much in options stuff yet, but it's coming. It's getting bigger because their expansion is really growing. But baby steps, right? Right now, you can connect your Tasty Trade account to TradingView, and that's where the data is coming from, which is really cool. But options data is massive. And I've always argued that if we could get traders who were coders, we could get a lot more done. And we're starting to get more of that. I think it's this one. We'll try. We'll see what if that's the one I think it is. Yeah, it looks like it. Yeah, the light version. So what we're looking at here is Apple, right? Okay, no big deal. Everybody knows Apple. It's got the IV rank up here, 5-day IV rank change, implied volatility move, and it recognizes what my chart time frame is and the highest positive GEX value with call resistance and the gamma wall to match that chart time frame. So it'll tell me, hey, between now and the next 65 days, matching this short-term chart that I'm on, these are your call and put walls and support levels and highest strike zones, along with your expected move model to match that time frame. And this is the free version. Imagine what you get if you buy the darn thing. I don't know. I don't buy indicators, but if I did, right, probably give me even more. So if I go into a higher time frame, it'll recognize that and it'll recalibrate everything. So now it's looking at options that go all the way out to 2027 because it recognized that I went to a weekly chart or a daily chart or whatever it is that you go to. It's pretty powerful stuff, right? And really useful information. Days to expiration, who's getting strikes, who's getting flow, what the skew is. That's the stuff that I look at when I go to my options chain. And now I don't even have to go to that options chain. I can just see it right here. Really powerful. So there are indicators worth buying is the point, right? That I didn't buy it, but only because I got so many subscriptions to like Spot Gamma, Trading Ticks, Voland. I don't need to buy it, but it'd probably be cheaper than any of the ones that I just mentioned. So pretty cool, all things considered. If you want the name of the indicators, I'm not trying to promote, that you go buy an indicator or something, but um, you can use the free versions. These are the three that I am showing on my screen right now. And the LITE word behind them is reminding you that I have the free versions. So if you get the full version, yours would have more. But look, I got Apple, Amazon, and Tesla and Oracle. Yay. Did the Dow is trash when it comes to options, so I don't care that they're offering it. That's like offering somebody uh, a peanut butter and jelly sandwich at a steak restaurant. Sure, you're not going to starve, but I'm sure you'd rather have a steak. The analogy made sense in my head. Most of the indicators that I gripe about are things like yesterday's high, yesterday's low, and then they want to sell you that, right? That makes me really mad. And I tend to talk a lot of trash on anybody that I see selling those kind of indicators because that stuff should not be sold, right? They should just give that stuff away. Yep. And that lights me up, man. That's one of my little pet peeves that it just frustrates the heck out of me. And I've had those kind of people reach out and try to buy the Thinkorswim workbook just to shut it down. Like, well, I can't make any money if you're just giving this stuff away. Like, yeah, well, find some other way to make money. I don't know. I'll get off my soapbox. When it comes to indicators, by the way, guys, I'm sure I've mentioned this before, but if you want to just poke around and you're trying to find new indicators, see what's trending and see what the editors really like. You go down to community and you have those three choices. And I have found really awesome indicators in there over the years. Because, I don't know it all and I don't know what I don't know. So I like to poke around and see what's going on out there, who's using what. And I just come up with finding new things I didn't even know existed. And like, oh, cool. Like that one with the tails on it that we were just looking at. That thing is absolutely amazing for trying to spot sector rotation, the Euler's loop. I love that thing. When I first found it, I was so excited. Eh, Already, huh? Hey, it is really cool. The it's just amazing. Make sure you pull it over. I forgot to show you guys this earlier, but it has, like comparative volume and a volume price ratio. It's got a lot to offer. And of course, you can hide price and load the indicator multiple times. And that way, you can get a really good visual of what's going on. And the best way to do it is you get it set up and then you save that chart so that every time you want to see it, you can just come right back to that chart every time and it's already set up with the sectors that you want, the industries all ready to go. And you don't have to fiddle fart around with it every darn time to get it set up again. It's just ready, it's done. If you want another one that's also really good for swing trading, see if I can find it. It's in the same time frame as that one because I found them in a group. Industry Group Strength. I love this one too. This one's smart. So let's. Oh, I'm on one. I was going to say let's go to a stock that it would recognize, but Amazon fits the bill. So I'm on Amazon and it says, "Hey, that's internet retail. What else do I have that is also internet retail?" And it goes out and looks and it says, "This is the peers that matches the stock that you're looking at. And in that peer group, these are the ones that are doing the best, and these are the ones that are doing the worst." Now, you got to admit, that's pretty damn handy. I like it. As far as I know, it does not do ETFs, but it's not supposed to, right? So I just put in SPY just to see what it would give me, and it gave me these other nations ETFs. But I always like running comparisons of peer groups. If I'm looking at airlines or pot stocks or whatever, I want to see all the names in that group that belong to it and who's doing what. So to me, this was really nice because I can't keep up with all the different companies, especially in like EVs for an example. It seems like every time we turn around, there's another EV company that's coming out, and so rather than trying to remember every name in the peer group, you can just run this uh, stock indicator and it'll tell you the peer group. And then it'll rank them by who's doing the best year to date, what their above or below their year to date level is. Like John Deere's up 19% year to date. I hate that company. Whatever. So that indicator is called industry group strength. The Monte Carlo is an absolute mess. Um, Tasty Trades got into that a few years back, so I understand what it's doing. Um, but to see it on the chart is just really ugly. It's trying to calculate the odds of where price is going to go next, and it's running forecast models more than one. It's just lines all over the place, and it's a complete mess. So I have it marked, but I didn't get anything useful off of that. The sticky notes is really good if you guys like to take notes on Thinkorswim, but you're now using TradingView, and of course you don't have that section anymore. That's a really good indicator. It does journaling, offers a to-do list, a checklist, just all sorts of really great stuff in that indicator right there. Not even Ichimoku theories. Wow, that's a whole other level. I know an entire community of traders who love this thing. Yeah, there are a lot of people who really like it, and I'm not one of them. But you know, to each their own. It's a lot like Elliott Wave in the idea that you can look back and explain the market with it really well, but I wouldn't want to use it for anything going forward. And it's not any more difficult than looking at moving averages at the end of the day. But yeah, no, it's not my jam. So those two indicators should be really useful for you. The sector rotation one, if you go to stockcharts.com, it will animate it for you, and you can look at it over like a few years and watch the model move. It's kind of neat, I guess. I'm a nerd, but if you don't care to see it move and you just want to see the tail, then Euler's loop will get you done. And then, of course, having the industry group is nice to find the peers, but it works on daily, right? So you can't go intraday with it. Not that it really matters. You're trying to find peers. I try. It's there's so many things to when it comes to trading that it I learn something new every day. Least I can do is try to help somebody else do that too. This is where I was describing getting kicked in the face today when I went short and we had that news that came in and ran me the heck over. So I was marking out where I had gotten in and what happened. I wasn't on a 1 minute at the time. I was on a five. So we had come up off of that low and we were stalled out here and it just started to roll over. And risk to reward was nice. So I went short there. And man, that bar just got flow and ripped all at once. It doesn't look like much here, but it was fast. It just ran me over. Yeah, it was like a bug in front of a fighter jet. Didn't stand a chance. Thankfully, I did have a stop, right? Usually on a slow day, I'll get a little lazy about using a stop because I'll be like, oh, I'm just going to manually run it. I wouldn't have been able to manually run that one. It ran so fast that it was done. Here's the 30-second sort of picture of it. It was quick, but whatever. It's my fault trading that close to the end of the hour. I know there's end of hour volume and new volume on the new hour, but it was a lazy day, and I didn't expect that we were actually going to get any, and I got my butt handed to me for it. When I was dabbling at different techniques, I had heard somebody say once that after every big win or big loss, that they would just shut it down for a good 5 to 10 minutes and pay attention to themselves, their feelings, their behavior, their breathing, their emotions. Are they shaky? Did they have, little goosebumps, whatever? And I thought after wins, I mean, sure, if you get your butt handed to you on a loss, maybe, but on the wins too. But he was right. If you get out of sync, you're out of sync. That's just all there is to it for whatever the reasons, wins and losses. And I've had really big wins that set me back. And I'm like, whoa, that was rare. Like when you get in short and then the market just falls the hell out and you're suddenly up 100 points, 100 points. When you had 7 contracts on it, you're just like, okay, I was not expecting that. I mean, hey, it happens. Time to sit back and just kind of reevaluate and get your mind right again. So it is absolutely advisable to really pay attention to yourself, and if you're having an off day, if you slept bad, you woke up pissed off, me, and I'm famous in my household for it. I do not like to wake up late. Say the alarm didn't go off or the power went out in the night and something happened and I woke up late. That is the worst thing for me, and it puts me in a bad mood, and it lingers and messes with my trading. It messes with the way that I sound when I talk to people, and it's just bad all the way around. So it sounds silly, but if you're having a bad day or you're having a really good day, it can affect what you're doing. Just pay attention to yourself because it matters. Yeah. Yeah, I've got a bit of a reputation for being salty. I don't know why. I'm the nicest guy you could ever meet, but I do come off a little grumpy from time to time. Yeah, it's uh it's all in good faith. I think this range is going to last to the end of the week. And I mentioned it in the morning briefing that we could probably run like a double calendar, double diagonal. You could maybe do an iron condor. I mean, I see the potential for it. I just didn't know this morning if there would be any money in it. We used to run weekly iron condors for people that haven't been around for years. There's this indicator that I have called a weekly expected move. And what we used to do every Friday on the live stream is we would develop next week's iron condors. And it was fantastic. I mean, we would spend, an hour or so laying out the butterfly levels, the iron condor trades, and we would do it for the cues, the spy. Hey, be careful of the heat when you get out there. Take some electrolytes with you. And this weekly expected move, there's a lot to it. But once you learn it, it's just a routine, and it's I like to call these mechanical trades so that you can put them on in any sort of market environment. Bullish, bearish, sideways, you don't care, right? It's all good. They're mechanical. No technical analysis required. You can just put them on. They were phenomenal trades. They have their own win rate, their success model. You know what your statistical profit targets are, everything. It was great until it wasn't, and it broke. It doesn't work anymore. The reason why it doesn't work anymore isn't obvious if you're new to trading. And I've had people who found those old videos. They're like, "Hey, I've been trying to run this and it isn't working, and I'm getting my butt handed to me. What am I doing wrong?" Nothing. You just can't run them anymore. This is our current week's range, right? And I just drew a box. It's not perfect. I didn't make it to the penny exact. I just drew a box, right? Now I'm going to take that box and I'm going to zoom out a couple of years. So this is a 40-day chart. Let's go out to 450 days. That ought to be that might not be enough days. Let's go out 1,000 days. So we're going to take this and copy it, and we'll just drag it with us. I lost it. There it is. And we're going to go back to before COVID. Um, a lot changed when COVID came. A lot changed. 1,000 days wasn't enough. I'm going to add another 1,000. Now we can see COVID way down here, and we're going to go pre-COVID. All right. So here's COVID up at the top. The S&P was at 3,400, and then the world crashed and burned and blah blah blah. This weekly range is the one for our current week. And I'm just going to bring it down and set it anywhere. It doesn't really it doesn't matter. Look at how wide the week's average was back in the day compared to how wide the week's average is right now. It's massive now compared to what it was, right? So when we would build an iron condor back in the day, we were building it with the wings much closer to price. And if you're new to options, that just means when you're closer to it, that you're going to get more credit for the trade that you put on. So we would make it $5 wide because it's the SPX. You can't get any smaller. And we could usually collect somewhere between like 80 cents and $1.20, which is really good for iron condors. Um, and it did mean that we were risking somewhere between 420 and 380 on average, but the win rate was in the high 80s. It was fantastic. And when you were wrong, you knew you were wrong pretty early. You wouldn't lose the full 420 or 380. You lose like half or a little more. The math was there. This trade worked, and you could do it on SPY, Iron, IWM, the Qs. It's great. But look at it now. Look at the range, how big these iron condors have to be. And what happens is you get so far away from price that when you actually try to build it, you end up getting like, if it's SPY, 5, maybe 10 cents on the dollar. You know what I mean? Like you can't risk $95 to make $5. You can't. There's no money in that. And another piece of the strategy that I didn't mention is that we were closing these trades usually at around 50% profit. So we would get like $1.20 and we'd close them at 60 cents because you increased your win rate doing that, which is why we were taking an 80 plus win rate strategy and we were hitting like 92, 93, 94%. It's fantastic. What the hell do you do with 6 pennies? Right? You can't risk $94 to make $6 and then cut that in half and take $3 profit. It doesn't work, right? So this really awesome trade just quit working because now the iron condors are so darn big that you can't get any credit for it. And here's what's even worse, the win rate went to hell. We don't stay inside the box like we used to. If you want to run a simple statistic, you just use numbers that end in zero, right? 10, 20, 50, something like that. Well, I like to use 10. 10's a nice, simple, easy number. If you count back the last 10 weeks, we should close inside this week's range. Ooh, that's loud. We should close inside the week's range 7 out of the 10 weeks. That'd be 70%. Well, count back the last 10, and you're going to find we didn't close even 50% of the time inside the week's range. And I don't use short weeks, so don't count the 4th of July. Just ignore that week completely. But we're not hitting even 50%. We should be hitting 70 to 80. So the strategy is broken. It doesn't mean that we can't use the weekly expected move lines, however. We can still do like butterflies, calendars, double calendars, those sorts of things. So a typical iron condor uses a model that looks a lot like that. And all we have to do is land inside the box, right? It's that tent. So we put on a trade and we say between this price and this price, if we stay inside this, we make money. And the wider out the two edges are, if you go wider, then this box gets narrower and the risk gets bigger and it just starts to get real ugly. Well, if you do a double diagonal, you can stretch those edges out a lot farther. So let's check a dynamic version. We've got the 18th coming up. It's got a $51 plus and minus from our current location. And we want to do round numbers because that's what we do in options to make things move fast to put on an options trade. So we're going to say we're at 62.65 round number, and we're going to add 50 to that. So that would be 63.15 on one side. Let's do one side here. 63.15. We need a credit spread. This is put, so we should have went the other way. Let's do the other side first. 62.65 minus 50 would be 62.15. We got one right there. I'm going to just pick these strikes and then adjust it. So we'll set the 15 to 10 and the 20 to 15. There it is. There's our credit spread on the bottom side. Right now, we'll put the calls on. And this is a dynamic iron condor based on the dynamic expected move, which is not the weekly expected move, right? We're just doing one. If we started it now, what would our range be? So there's the puts, and then we need 60, what did I say, 63.15. I don't have a 15 showing, so I'm just going to cheat like I did the last time. I'll use 305 and 310. and then just push them up one, right? There's 15 and there's 10. That way I didn't have to, add more strikes and all that stuff. So here's almost a $2 iron condor for a $5 wide trade. So we're risking 3 to make 2, and we're running it on the expected move model. So we had a 70% chance win rate. That's not bad, right? But when we were building these, it was Friday afternoon and it was for next Friday's expiration. And there's just, it's just too big, right? Hey, glad you got something out of it. Um, for topics on this Friday, guys, I'm always open, for topic requests. Anything you guys want to hit, let me know in advance. I'll get some material, put it together, come up with something, whatever it is you guys want to work on. So this is that iron condor. Let's make sure I don't have any of these old trades. And there's the iron condor, right? And you can see that we're risking $3 for a chance to make $2. But look at the gray box. The gray box is representing the market's move model, and our lines are inside that move model. We're at risk of getting hit, right? We would want to expand our wings farther than that. And if we do that, how much credit we get is going to go down, and how much we risk is going to go up, right? So we have to adjust things. And the wider we make this, the more likely we win, but also the more pain we're going to get if we don't win. And it's just bad, right? So, what I came up with was, instead of doing these, we should do something like a double diagonal. A diagonal, if you're not familiar with the trade, uses 2 expirations. So, what we were building was 2 verticals. We had a vertical on the call side and we had a vertical on the put side, and we sold to open both of those. And 2 verticals like that creates an iron condor. But we call them a vertical because we moved vertically on the options chain. We had one here and one here. That's a vertical move. Or, we had one here and one here, and that's a vertical move. And that's why we call them verticals. When we call them diagonals, well, that just sounds weird, right? But what we're doing is we're moving laterally, diagonally through time. So if we was going to put on uh, that sort of trade for next week, we could use something like Friday's expiration, the 18th, and then Monday's expiration. And we could do something like 63.15 short. Remember, I don't have the 15 showing, so I just use the 10 and jump at one. And then we can go long on the other one. That is a diagonal, except that I need both of these to say 15, and now it's going to say it's a calendar. Well, it didn't, but that is a calendar, right? A calendar is where you use the same strike on both, which is what I just did. A diagonal is where you have the strike on one and then you have a different strike on the other expiration. So we have a calendar date change, and we moved diagonally in that date change. And we have to pay for this one because they're the same, but they don't have to stay the same. We can kick one off. So if we do go to kick one off, we needed 63.15 and we needed a 63.20. So let's use a 20. Well, it lowered the debt, but it didn't get us there. We'll leave it there for a moment. We might have to play with this a little bit. Let's just send it over to the Analyze tab. And I've got videos on this on the Bullish Bears website. After the weekly expected move broke, I went in and figured out how to solve the problem. If you go to the website, you'll want the video that talks about the Marcus trade, because that's what I ended up naming this, is the Marcus trade. So that's one diagonal right there. And diagonals don't have a fixed profit and a fixed loss like a vertical does. And that's because these can expand and contract based on volatility. So the ones on the upside, this is the call side, it's the upside, they wouldn't expand if price rises generally, because volatility goes down when price rises. But the put side, puts expand when volatility expands. So the puts value really increases. And when we put the put diagonal on here, if the S&P falls into it, they're going to swell up, right? And it'll create like this bat ears or cat ears looking sort of chart. And the entire range will be a profit zone from like 63.20 all the way down to 61.20. At 200-point zone, if price is anywhere in there, you make money. You know what I mean? Like that's way bigger than the iron condor, and you'll make more money for it too. So it's a really good trade, much better than the iron condor for the weekly expected move. The problem is diagonals scare people. They're a little complex because they use multiple expirations and it just freaks people out. But they're worth learning because they are fantastic. And there's so many ways you can run them, right? Lots of lots of ways to manage the trade and defend them, and they're just fantastic trades. So guys, if you don't have anything specific, let's wrap it up and call it a day. And we'll come back at it tomorrow in the morning briefing. Yep, yep. Everybody, have a good night. I'll see y'all tomorrow. You're good. I just ended.